Hi, everybody. I hope you're all doing well. I know we are living in challenging times now, but I'm sure things will get better very soon. So please do hang in there. Welcome to another episode in this foundation series in accounting, where we look at topics covering the basics of accounting. In this episode, we are going to look at liabilities. So, what are liabilities? How do we define them? And how do we classify them in the financial statements? Let's begin by looking at the accounting equation. The accounting equation is represented by assets equals liabilities and equity. Assets are resources that are controlled by the business and used to generate revenues and profits. Liabilities and equities represents claims on these resources. So we use the accounting equation to analyze and record business transactions. And the accounting equation is then reported in the statement of financial position. Now let's focus on liabilities. Liabilities are defined as a present obligation of the business to transfer economic resources to another party as a result of past transactions or past events. So a liability exists at the reporting date if there is a present obligation arising from past events or past transactions, and this present obligation requires the business to transfer economic resources to another party at a specific date in the future. So let's take, for example, if you had borrowed money from the bank sometime in the past, and this amount remains unpaid at the reporting date, this will result in a present obligation to the business to repay the bank sometime at a specific date in the future. And therefore, the business will then have to report at the reporting date in the statement of financial position liabilities of bank loans. Let's now look at another example of liabilities. Let's say the business had purchased goods on credit sometime in the past. And if this purchase have not been paid at the reporting date, then the business would have a present obligation at the reporting date to pay to the creditor sometime in the future. So as a result, the business would have a liability in the form of creditor and will need to report this in the statement of financial position at the reporting date. Another example of liabilities could be that a business may have used up certain resources in the past, such as electricity. And if the amount remains unpaid at the reporting date, then the business would have a present obligation to repay for the use of the electricity sometime in the future. So as a result, the business would therefore have to report a liability in the form of accruals in its statement of financial position at the reporting date. Another example of liabilities could be that the business may have received cash in advance for its products or for its services sometime in the past. And this receipt of resources gives rise to a present obligation to provide services or products in the future. So if this amount have not been satisfied or have the products or services have not been provided for at the reporting date, then the business would have a present obligation to provide that service or provide that product sometime in the future. So therefore, the business would have to report liabilities in the form of what is termed as unearned revenue in its statement of financial position at the reporting date. Let's now take a closer look at the term present obligation. A present obligation refers to the duties and responsibility of a business to another party. What does duty and responsibility here mean? Duties and responsibility here means that the business has no practical ability to avoid doing certain things for another party. So, for example, if you had borrowed money from the bank, you cannot avoid paying the bank, because if you don't pay the bank, then the bank can take legal action against you. So therefore, in most cases, a present obligation would arise because of a contract or an agreement or even a regulation that is legally enforceable on the business. However, not all present obligations are due to a legally enforceable situation. Sometimes, depending on what the business has done or the actions of the business, a present obligation may also arise. We call this a constructive obligation. Let's look at an example of constructive obligation whereby a business had inadvertently polluted a stream that was nearby the premises of the business. Now, let's say that there is really no legal obligation, there's really no regulation that compels the business to clean up the river. But let's say the business decided that they will still clean up the river due to their corporate social responsibility. So, what they did was they then announced it to the general public. Now, once they've made the announcement to the general public, the business now has a constructive obligation to carry out the cleanup of the river. Because if they don't carry out the cleanup of the river, then there would be negative publicity that will have an adverse impact on the business. So, as a result, the business would have a present obligation to account for the cleanup cost of the river, and they need to report this as a liability in the statement of financial position. So, in summary, liabilities exist as a result of a past event or past transactions that gives rise to a present obligation to the business, gives rise to a duty and responsibility for the business to transfer economic resource sometime in the future to another party. Now, in most cases, this transfer of economic resources, the timing and amount is known with certainty. So, for example, in the case of a bank loan, when you have to pay the bank and the amount that you need to pay to the bank is known with certainty. However, there are certain situations whereby the amount and timing of the transfer of economic resource is not known with certainty. So in these cases, we record what is known as provisions. So provisions are really liabilities, but the timing and amount of the transfer of economic resource in the future is not known with certainty. So that means that there is present obligation. It's just that we are not so sure when and how much we will need to pay to the other party. So let's look at an example to illustrate what provisions may be. So let's say the business had sold some goods to its customers, and this sale came with a warranty period. So let's say a warranty period of 1 to 2 or 3 years. And within this warranty period, if the customer found any faults in the products that they have bought, they can come back to the business to either look for a replacement or to get it repaired at no cost to the customer. So the business will have to bear the cost of replacement or the cost of repairing the product. So as a result, this warranty has given rise to a present obligation to the business to honor this warranty for their product. And this warranty would require the business to transfer economic resource in the form of repairing the products or replacing the products at no cost to the customer. So the business will have to bear these costs of repairs and replacement. So as a result, the business would have to record what is known as a provision because there is a present obligation as a result of a past event, in this case, a sale, which comes with the warranty. The only issue for the business is that they may not know exactly when the customer will come to claim and the amount of the repairs that will be required from the business. So as a result, the business will have to estimate these provisions. How they estimate these provisions, they can actually look at past trends of similar claims by similar groups of customers. So therefore, a provision is actually a liability that whereby the transfer of economic resource is actually estimated. So liabilities, including provisions, represents present obligations of a business at the reporting date. And these present obligations will be reported in the statement of financial position as liabilities. These present obligations require the business to transfer economic benefits or economic resources to another party sometime in the future. If the business are required to transfer these economic resources within a 1 year period from the reporting date, then these liabilities are classified as current liabilities. If, however, the present obligation requires the business to transfer economic resources beyond a 1 year period from the reporting date, then these liabilities are classified as non-current liabilities. So there is another form of liabilities called the contingent liabilities. Contingent liabilities are not included in the statement of financial position. It is only reported in the form of a note to the financial statements. So, what are contingent liabilities? Contingent liabilities are possible obligations that have resulted from a past event or past transactions. So these are possible obligations, no, not yet present obligations. And whether it is going to be an obligation or not depends on the outcome of a future event, which is currently at the reporting date uncertain. So let's look at a simple example to illustrate what contingent liabilities may be. So let's say this business runs a food and beverage outlet, a restaurant, and a customer who had a meal in your restaurant in the past have felt very ill, and as a result, the customer had lodged a legal suit against the business for negligence. Now, this legal suit is still being deliberated within the court's structure, the court's process, and the outcome is not known at the moment. So, as at the reporting date, the business do not have an obligation to compensate the customer, at yet. It all depends now on the outcome of the court judgment. So what happens is that because this information is still useful for the users of financial statements to have an idea whether there may be a claim against the business sometime in the future, we will report this by way of note into the financial statements. We don't record it yet in the statement of financial position as a liability simply because there is no present obligation yet at the reporting date. So that's what a contingent liability will be. So I hope you've found this video useful, and also it has helped you better understand what liabilities are. Please do like and share this video, and also please do subscribe to my channel, and please remember to click the bell icon so that you are notified of new videos that I release on the foundation series in accounting. So till we meet again, please do stay safe, stay strong, and please take care.